Hey, what is up, everybody? This is Andy in Business Development and Mortgage Heroes, and I'm actually making this video. It's a little bit more of an extended video than you might be used to, but I want to talk about something that hit the housing wire this week. Actually, the story originates in December of 2019, but an updated story came out this week, and I wanted to talk about it. So I'll put both links to the stories down here. This is from housingwire.com. It is a mortgage and real estate resource that has a lot of information about the market, what's trending, economic data, analytical data, and then also just stuff about what's hitting the marketplace as far as products and services are concerned. So today I'm going to talk about something that I'm going to call Fleq. I don't know if it's supposed to be Fleq because it's not spelled the same way, but it's F-L-E-Q. Now, what we're going to discuss really quickly are a couple of initial reactions. I have a bunch of notes here, so I make sure I cover everything because this is important to us. So we're going to cover initial reactions. We're going to talk about what's good, what's bad, and then some questions I have about it. So let's dive right in. Okay, so the first thing is that in December 2019, Fleq met with Housing Wire, and the title is Startup Plans to Allow Consumers to Purchase Homes Without a Mortgage. Is it innovative or risky? That is the question. Now, the first things first is the first sentence says, one new Los Angeles-based investor-backed startup. First of all, investor-backed startup. That should already tell you where's the money coming from and where do they want the money to be returning to. And it's talking about getting Americans into homes without requiring a mortgage. Now, I'm not going to be a naysayer, but that's a tall task to try to tackle because as it is right now, as of the end of quarter 3, 2019, Americans owed $15.8 trillion in mortgage debt. And to make a dent in that at even 1%, is a huge, tall $150 billion task. Just hold that note for a second. So anyways, the whole idea here is that they want to create a new product in the marketplace specifically for millennials or Gen Zers for this reason. We didn't think that mortgages were the appropriate and fair approach to homeownership, and we didn't think it resonated with millennials and Gen Zers who saw their parents wiped out by the financial crisis. Let's stop right there for just a second. First of all, the financial crisis that happened really started in 2007, but really took hold 8 and 9, that wiped out not even a majority of people. It wiped out a lot of people, but let's be very clear. The housing market and mortgage market was a catalyst inside that. It was not the end-all be-all for the collapse. It was a 4-leg table and all 4 legs fell out, okay? First thing, people's 401ks were slaughtered, shareholdings were shredded, and even mutual funds tanked. So even things that we consider safe for long-term future gain was victim to the collapse as well. The other thing I want to say real quick is that people bounce back. I mean, the fact that we're here is evidence of people bouncing back. At that time, we had already started this business. We'd already purchased an office and then a second office. We had to give that one back. We all lost something in the market, but we were all still here through the market and are still here now. So that also says something that people shouldn't necessarily be fearful of a huge market shift like that or a collapse because you can come out of it. We're living proof of that. And then the last thing is I'm going to harken all the way back to the Depression. Now, my grandparents, specifically on my mother's side, they lived here. They were born here and lived here in the United States. And when the Depression hit in the end of the 20s, they pressed on. They were teenagers, and so they had this Millennial and Gen Z experience of a collapse. And they pressed on. They got conservative, they reused resources, but they kept their head up and they kept marching forward and they kept pursuing a dream of working and having a livelihood and enjoying the benefits of living in a free nation. And so, using this excuse or this explanation of, we saw these Gen Zs and millennials seeing their parents wiped out by the financial crisis. Yeah, okay, I get that. But also, I don't know that warrants having to create an entirely new product to solve the housing problem. And this actually doesn't solve the housing problem. We're going to get to that. So that was kind of like the baseline of this whole first article. Is that Their opinion is that using a mortgage wasn't the best way to buy a home, but they're actually offering the exact same thing and just calling it something different. And let's get into that. So the article that just came out this week, dated January 20th, 2020, and it says, here's how to use Fleq to buy a home without a mortgage. Startup explains this new approach to home ownership. Now, a couple things. First of all, they're saying that they separate you from your obligations as an owner to the property and those obligations that come from living in the property. But that's never true when you're occupying a property. Let's make that thing straight. Whether you live in an apartment, a condo, a townhome, someone's garage, a basement, an attic, or a house, or a mansion, you still have obligations to take care of that place. And if you fail to meet those obligations of taking care of it, it will deteriorate. The inside, the outside, things are not made perfectly, and things over time age, get old, break, and need repair. So this whole idea that it's going to eliminate the obligation of homeownership, not true. Even having been a homeowner and even having been a tenant before, I still had responsibilities personal responsibility for the place I lived at, keeping it up and keeping it to code to some degree so that it was safe for me and my family to live in. There's my point on that. Now, let's talk about what is going to be the issue with people participating financially in a product like this. Now, what they're saying here in this detailed explanation in the second article is that they're using the example of Jane. She finds a dream house for $200,000, and then she creates a partnership with Fleq, calling an alliance and a partnership to purchase the home. Now, if she wants to have an equity stake in the house, let's say she puts 5% down, she'll own 5% of the equity. And then they'll rent her the home back, so she makes a monthly payment towards the part of the balance of the home that she did not put money down for, which is the same as putting 5% down for a mortgage and having a 95% mortgage, 95% loan to value. It's literally no different. The wording is different. Now, here's the part that's a little bit of a challenge for me, is in this, we're going to lose a lot of people, because where they're saying she gains or loses equity is contingent on the market valuation, when she buys, the contracted approval price, whether her credit is approved or not approved, whether the house passes the appraisal and physical inspection, there are no major repairs, there's no detail of what major repairs are. We talk about a roof that's missing, we're talking about a sloping foundation, a cracked slab, like what are you actually talking about? That's also unknown. And then in order for someone who's going to participate in this financial product, they're going to have to understand not only market valuation, they're going to have to understand market trends. They're going to have to keep a finger on the pulse, in my opinion, if they don't want to lose their shorts in the transaction. And other fundamentals, I'll just say fundamentals of like trading or fundamentals of buying and selling, buying low, selling high kind of thing. And all this I'm saying within the context of the market doing whatever the market's going to do without ever asking you. The market does not ask you if it wants to go up or down. The market does not knock at your door and consider your opinion on whether you want your house value to go up or down. It never asks. So in this situation, she may be putting a little bit of money down, but she still has a payment, which is being paid towards Fleq, who's the alliance partnership with her, and is to pay whatever cost they have that is packed into that monthly payment she makes, the cost of running their business, plus their profit, which is baked in. And this leads me to another point, which is casinos are so rich and extravagant because they never lose. Now, I have friends who have won big money at the casino. However, the casino day in, day out, it wins because it sets up the rules, it sets up the games, it sets up how you can play. It controls the terms and conditions for which you participate in the financial risk and the gain or the loss. And so because they set up the rules, the house can always win. And that's unfortunately what I see happening here. Now, there's other things mentioned, like there's a membership fee. Well, like what's their membership fee for? That kind of sounds to me like timeshare-ish, which it may or may not be. Again, I don't know. And, they do mention things like, well, we don't know when the HVAC is going to break. And so there's always some considerations for that kind of thing. Well, that's why when you're in a rental position, you pay rent of X amount a month. That owner or that property manager should be baking into the amount you're paying the cost to fix any of those things that happen along the way, such as a broken dishwasher, or again, like they mentioned, the HVAC system. And again, I'm going to just make another comment. Like, we don't know what they consider major repairs. I have no idea what that means and how major things may or may not be. Here's what I want to tell you is I don't think this is revolutionary enough. It might be something to start a conversation. I ultimately think what's going to happen is that this concept is going to get picked up by someone bigger in the marketplace, and maybe that's their play. Maybe that's this investment group's play, that they want to create something to get a conversation started, get some seed money or some seed case profiles together, and kind of prove the viability of this in the marketplace, and then have someone bigger kind of swallow them up. They even mentioned in their article that when you're looking for a home on Zillow or Redfin, or your local realtor, mentioned third. So they kind of mention in that order. So to me, if I'm reading between the lines, it might be that they are hoping that one of these other big guys kind of gobbles them up and then offers this as a third alternative to renting or buying in a traditional mortgage. Let's talk about a couple things that are potentially bad, as if I haven't mentioned enough already. Number one, follow the money. So how does this, ask how does this work from a flow of money perspective? Who wins if you own only part of a home and not all of a home? Yes, I get the argument that if you own the home and you have a mortgage, you are on title, but you still owe a bunch of money. Market goes up, you have equity, you could sell, refinance, whatever. Market goes down, well, you can't sell for a profit. You sell at a loss, which means you owe money to the bank, but then you don't sell. I think that's what's going to happen with Fleq too, is if the market goes down, people who are in this agreement aren't going to sell. The problem I have with it is that as you are making payments against your agreement with Fleq, and if the market is going down, you still don't own it. So at some point when the market corrects itself and you want to sell, you will continue to have been paying like as you are in a rental, and then you still only have a proportionate amount of the equity. So I can't wrap my head around that economically yet. If that's an immature perspective, I'll own that in the future when I look back at this video. But right now, I'm having a hard time seeing that that's smart for somebody. And that leads me to the next point, which is, what happens if you buy a house at the top of the market and you only put 5% down or 10% down? Now, the risk if I buy a house is that I have a mortgage for 90% or 95%, and I have to ride that market out. Well, you'd have to do that here, but you only know where the top of the market was by looking behind you, by looking back, by looking at statistical analysis after the fact, after all the tail of the tape comes in. And that is, I think, a potentially risky prospect for people who are going to consider this type of financing. To me, when I read more about this, it sounds a lot like a timeshare, but instead of booking dates you want to, live at the place during the week or the month, you're just booking it for every day of the month, every month, for however long that term and conditions for. Here's the thing I think that probably bothers me the most. Having been in this business for so many years, Fleq will provide you with a quote for your estimated monthly payment, which is your rent and your ownership costs and fees, as well as your initial equity contribution to the alliance. Fleq provides you. Now, there's no other way around that. And with 15 years of mortgage industry experience, one thing I've learned is, like, at the end of the day, price is price. But you always negotiate deals based on terms and conditions. And if you have no seat at that table, then you are going to get what they give you, which further proves the point of follow the money and the house always wins. So that concerns me a lot, because it's that Fleq gives you. It's not that Fleq and you figure out. You can still negotiate the terms of your real estate contract, but it does not sound like you can get to negotiate the terms of your payment every month, where in the mortgage world, you can. You have choices when it comes to buying down your rate. If you want to pay points, you can use closing costs towards buying down your rate. How do you do that with Fleq? I don't know. And what's Fleq's formula for determining how much you pay every month and whether or not you can pay less than what it is they're offering you? You're stuck with whatever they're giving you, which I'm going to tell you right now is going to be whatever makes them money still, with a pad in between for whatever potential cost loss they have, or potential future cost and loss they have down the line. That's not yet realized today, but will be in the future. Mark my words. Now, how does the rental part of the property you own get sorted out? Like, I don't understand where they're gonna get market valuations from. How do you get to chime in on whether they're even like using the right comparables? What market data are they using? How old is that data? I mean, there's a whole list of considerations an appraiser has to make when they're giving comparables for a property, but I'm not sure how they're going to align how much they're going to charge the Fleq partner based on how much they put down compared to how much the money's costing them, whether it's investor money or market money that they're playing the market to obtain this financing for. I don't know that. I think not knowing that is a big red flag for me, and I'm not sure how that will fare, speaking back to the point of it being complex and people not understanding how intricate mortgage money is and where it comes from, and how the economics of our national economy and even global economy affect whether money comes in or flows out of the mortgage market, which means rates go up, which means rates go up or go down based on the supply and demand of money. I just want to make sure I make this abundantly clear. Just because you call it something different doesn't mean that you're not having a mortgage. If you have a monthly payment, you have a monthly payment. You can call it a mortgage, you can call it a rent, you can call it my Fleq partnership. I think the difference here is in the level to which you participate and the level of risk you want to take, the level of reward you're willing to accept, and how close you are to the proximity of how the decisions are being made in the deal that you're walking into. So I have a great deal of caution getting behind this for anybody, and I can understand if you're watching this and you're like, yeah, it's just because you don't understand it or you haven't had someone explain it to you. But again, like understanding the fundamentals of the money flow, of where money comes from, how money for mortgages becomes available, how our real estate market is propped up, and even new players in the market. And I'll say relatively new, meaning the online iBuyers, iSellers, the Zillows, the Redfins of the world and all that. The fundamentals are still the fundamentals. Is that there's a buyer and there's a seller, and there's a process. So there's a buyer, a seller, and a process. They're introducing a new process, and this new process has a lot of question marks and a couple of red flags that I just am a little hesitant to get behind. So, essentially, last thing is, the company says that once the buyer pays 100% of the home, it will hand over the title, cutting any mortgage payment down or interest rate out of the process. But that's exactly what a mortgage is. Except you're on title from the beginning when you have a mortgage, and if you pay off 100% of a home, you own it outright. There's nothing different there, so there's nothing new and innovative in that. But what happens if they move out early? You split the profit. But what if Fleq doesn't want to sell the house, but you do? They have to find a replacement. Are you allowed to move out when you want to, or you can only sell your position when they have a buyer in line? Or can you sell your position back to them and they give you part of your money back? There's a lot around this that separating and or paying off your home via the Fleq process that I think remains to be seen. So that's my 2 cents. I know that was more like $1 and change, but I'm gonna put the article links here. I want you to read them, and if you have any feedback or you want to discuss this with me, I would love to learn more about this. And I'd also love to know if there's something I'm missing. If there's something I'm missing about this, please tell me. And if you are a millennial or you're a Gen Z buyer, if you're a millennial or a Gen Z home buyer, I want to talk to you. I want to understand what is intriguing to you about this, and actually if this is a problem that this generation is looking to be solved, or if this, again, is just an investment-backed new company, startup, trying to wedge themselves in between something, create some market space, and kind of stir up something so they can eventually just sell off to somebody for a nice payday. Please let me know what your opinions are. I really do want to talk to you if you are a person who is considering this, or you heard about this and you're considering. I want to know why. I want to know what things on the other side of the fence are you looking at that you think are of an advantage to you or a benefit to you, even knowing all the potential risks. So thank you guys for watching this long extended video. I appreciate you spending the time with us today, and we'll catch you again soon for some more market opinion analysis. Also, remember to subscribe to Mortgage Heroes on YouTube, where you can always get Monday Mortgage Minute, where we take a sneak peek at the market and what's coming up ahead every Monday for 1 and sometimes 2 minutes. Also, you want to subscribe to Week in Review, where you see all the behind the scenes of the Mortgage Heroes office and sometimes some of our adventures out of the office, when everything that happens in and between those phone calls, emails, and texts we get to you and from you as clients. There's a lot of fun stuff that happens here around the office, and we're trying to make this place as fun as possible, because we know sometimes mortgages can just be flat out boring, but why not have some fun along the way? Catch up with Week in Review, and we'll see y'all next time.